What the top 1% of investors do differently than you. Did you know that Warren Buffett once made a bet that left Wall Street stunned and won? In today's video, we're exploring the unique strategies of the top 1% of investors, including legends like George Soros and Carl Icahn, and what sets them apart from the average investor. We'll uncover the less talked about habits and decisions that have not only defined their careers, but revolutionized investing. Stay with us to find out how you can apply these insights to your own investment strategy and possibly improve your financial outcomes. This could change the way you think about investing forever. Warren Buffett. Warren Buffett, often called the Oracle of Omaha, is celebrated for his exceptional investment strategies that have consistently beaten the market over decades. His approach to investing is distinctly characterized by a combination of patience, value investing, and a profound understanding of business fundamentals, which differentiates him from other investors.
People would say, well, why in the world would I buy it? And you aren't investing when you do that. You're speculating. There's nothing wrong with it. If you want to gamble, somebody else will come along and pay you more money tomorrow. That's one kind of game. That is not investing.
Buffett's investment philosophy can be distilled into a few core principles. Investing in businesses that have a clear competitive advantage, often called moats, are easy to understand and are available at a price that makes them an attractive investment. Buffett prefers companies with excellent management, good return on equity, and strong market positions. His strategy focuses not on the fluctuations of the stock market, but on the performance and value of the businesses behind the stocks. One of the most defining elements of Buffett's strategy is his long-term investment horizon. Unlike many investors who chase short-term gains through frequent trading, Buffett chooses to invest in companies that he believes will offer sustainable value over decades. This allows him to benefit from the power of compounding as his investments continue to grow over time without the costs and distractions of frequent buying and selling.
And that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today, because that gives you a different perspective on it. Then presumably if you buy a farm, if you buy an apartment house, if you buy a business, you're going to own it for 10 or 20 or 30 years. And the real question is has the 10-year or 20-year outlook for American businesses changed in the last 24 hours or 48 hours? And you'll notice many of the businesses we own, partially own, American Express, we've owned it for 20 years. Coca-Cola, we've owned it for 40 years. Those are businesses, and you don't buy or sell your business based on today's headlines. And if it gives you a chance to buy something that you like, and you can buy it even cheaper, then you're good luck, basically.
At the heart of Buffett's strategy is the concept of value investing, which was pioneered by his mentor, Benjamin Graham. This approach involves identifying companies that are undervalued by the market but have solid fundamentals. Buffett looks for opportunities where he can buy these undervalued stocks at a price lower than their intrinsic value, providing a margin of safety and setting the stage for substantial future gains.
10,000 some pages twice looking for companies, and you have to find them yourself. The world isn't going to tell you about great deals. You have to find them yourself, and that takes a fair amount of time. So if you're not going to do that, if you're just going to be a passive investor, then I just advise an index fund bought consistently over a long period of time. The one thing I will tell you is that the worst investment you can have is cash. Everybody's talking about cash being king and all that sort of thing, but most of you don't look like you're overburdened with cash anyway. So, but cash is going to become worth less over time, but good businesses are going to become worth more over time, and you don't want to pay too much for them, so you have to have some discipline about what you pay. But the thing to do is find a good business and stick with it.
Buffett's investment success also rests on his exceptional discipline and patience. He waits for the fat pitch, a term he borrows from baseball to describe an investment opportunity that is right in his sweet spot and too good to pass up. This discipline means he often holds large amount of cash during market highs and waits for prices to become more reasonable before he buys.
But you do need discipline. You have to wait until you see the fat pitch to swing at. Because investing is a no-called strike game. If I were a baseball player and I only like pitches 2 inches above my navel, some guy could learn that and he could pitch me, 3 or 4 inches below that, and I get called out on strikes because I never find a pitch I like. You can get called out on strikes in baseball. You have to swing at pitches that you don't even necessarily like, particularly after the count gets to 2 strikes. In business, you don't have to swing at anything. You can sit there and the paper says General Motors at 68, or it says General Electric at 115, or it says General Dynamics at 63. And if you don't like those prices, you don't have to swing. You can wait there day after day after day after day, and there are no called strikes. Now, when you swing, when you decide to buy something, then, if you swing and miss, it's a strike. But it's a marvelous game to be in because there are no called strikes, and you can simply wait for that one time in a month or 6 months or a year or 2 or 3 years when you really know what you're doing, where you like the price, where you like the people running the business, and then you swing, and you only need a few swings in your lifetime.
Contrary to the typical advice of diversification, Buffett maintains a concentrated portfolio, holding significant positions in a relatively small number of companies. He argues that diversification is a protection against ignorance, but if you know what you are doing, you don't need it. By concentrating his investments, he can focus on understanding each business deeply and making more substantial investments in those he has high conviction in. Buffett's approach isn't just about making money. Ethical considerations and philanthropy are also integral. He plans to give away the majority of his wealth to charitable causes, primarily through the Gates Foundation, reflecting his belief in responsible wealth stewardship and the social duties of the wealthy. Warren Buffett's investment strategy exemplifies how understanding deep business fundamentals, coupled with patience and ethical responsibility, can lead to superior financial outcomes. This disciplined approach to investing in life sets Buffett apart as a model for investors worldwide. George Soros. George Soros, one of the world's foremost financial figures, is best known for his hedge fund management skills and particularly for his speculative success, including breaking the Bank of England. Soros's investment style is highly distinctive, marked by a blend of global macroeconomic analysis and understanding of the reflexivity theory, and an acute perception of socio-political events which he integrates into his investment strategies. Soros is often considered the most successful global macro investor, which involves betting on the movements of currency rates, interest rates, stocks, bonds, commodities, and other assets based on macroeconomic analysis. Unlike many investors who focus on the intrinsic value of individual stocks or sectors, Soros look at a broader economic landscape, including international economic indicators, country-specific policies, and geopolitical risks. His decisions are based on identifying large, sweeping global changes.
The efficient market hypothesis. Therefore, they deserve special attention. But reflexivity can take many other forms. In currency markets, for instance, the upside and downside are symmetrical, so that there is no sign of an asymmetry between boom and bust. But there is no sign of equilibrium either. Freely floating exchange rates tend to move in large, multi-year waves. The most important and most interesting reflexive interaction takes place between the financial authorities and financial markets. Because markets don't tend towards equilibrium, they are prone to produce periodic crises. Financial crises lead to regulatory reforms. That's how central banking and the regulation of financial markets have evolved.
A cornerstone of Soros's approach is his theory of reflexivity, a concept he developed that suggests markets are constantly influenced by the biases and actions of participants, which in turn influences those same participants in a cyclical pattern. This theory posits that markets do not always behave rationally or in line with the economic fundamentals due to these feedback loops between market prices and the fundamentals, which may lead to mispriced assets and irrational market trends. Soros's strategy often involves betting against these mispricings.
Math. So I rather question the assumptions on which the math was based. And that's how I came to this recognition that economics ignored this fundamental difference between natural phenomena and social phenomena, because in natural phenomena, the imperfect understanding which is part of human nature, unavoidable, doesn't enter into the sequence of events that you are studying. So you can actually establish universally valid laws which can be used both to predict and to explain. And it's actually a really beautiful construction, natural science.
Soros is known for his high-stakes trades. Perhaps the most famous is his bet against the British pound in 1992, which earned him over $1 billion and led to the pound being withdrawn from the European exchange rate mechanism. Soros' willingness to take on significant risk is a hallmark of his investment style, often leveraging his positions to maximize returns. Soros is intensely involved in the management of his fund, displaying remarkable flexibility in changing his positions. He believes in actively managing investments based on shifting economic conditions and political developments. His ability to swiftly adjust his strategies in response to changing market dynamics is a key factor in his success. Beyond just economic indicators, Soros also places a strong emphasis on socio-political events, understanding that these can significantly impact markets. His extensive knowledge of global politics and economic policies enables him to anticipate market movements that others might miss. Like Buffett, Soros integrates his ethical values into his career. He has donated billions to philanthropic causes through his Open Society foundations, focusing on promoting democratic governance, human rights, and social justice worldwide.
In the world today, because there's overcapacity, demand is of course at a low level, and companies have to sell in order to generate positive cash flow, in order to pay their debt. Mm-hmm. So now there's very little pricing power. Profits are under pressure. Investment demand is liable to decline since there is overcapacity. It is possible, although less likely today than it was 2 months ago, that the whole world economy slips into a recession.
George Soros' investment methods, characterized by an integrated approach of economic theory, a deep understanding of market psychology, and a courageous approach to risk, demonstrate how an innovative mindset combined with a robust analytical capabilities can lead to vast success in the global financial markets. His strategies, marked by a deep engagement with global economic realities and a commitment to social change, make him a distinctive figure in the world of investment. Carl Icahn. Carl Icahn is a prominent figure in the world of finance, best known as a fearless activist investor. Unlike traditional investors who may passively invest in stocks, Icahn is actively involved in the companies he invests in, often pushing for significant changes to increase shareholder value. His approach centers around taking large positions in undervalued companies and then acting as a catalyst for change. At the core of Icahn's strategy is his role as an activist investor. This means that he doesn't just buy shares in companies, he tries to influence the company's operations, management, and strategic direction. Icahn looks for companies that he believes are poorly managed or have inefficient business practices that he can improve upon. Once he acquires a significant stake, he often seeks positions on the board of directors, pushing for changes that range from management shakeups to restructuring or even advocating for the company to be sold.
We and many activists are not short-term oriented. I can't say all of them are. It depends. I mean, if you have partnerships and people want to get returns, I guess you have to be somewhat short-term oriented. But the real money that I made over the years is holding companies for 7, 8, 9 years and keeping them. I've looked back. We bought casinos, and you got to buy them when nobody wants them, really. I mean, that's the real secret. You buy things. It sounds very simple, but it's very hard to do. When everybody hates it, you buy them. And then when everybody wants them, you sell it to them. And that's what we do.
Icahn specializes in finding undervalued companies where he sees potential for improvement. He targets companies that he believes have strong fundamentals but are undervalued due to inefficient management or other internal issues. His goal is to unlock the true value of these companies through aggressive management changes and restructuring strategies. A key aspect of Icahn's investment approach is his adeptness at negotiation and persuasion. Once he invests in a company, he uses his influence and stakeholder position to persuade other shareholders and board members to implement his proposed changes. His formidable reputation and track record in improving company value make his arguments compelling to other investors who may be unsure about the need for change.
What we do, and we go in and we clean up a company. There are many companies in the country that are very well run, but many are terribly run. And you don't have corporate democracy. You still don't. So you have people that run companies that aren't bad people, but shouldn't be running the companies. They're way over their heads. Or they have different agendas. So if you think about it, this is corporate America. If your uncle left you a vineyard, or a beautiful vineyard, beautiful apple orchards, beautiful farm, he left you the vineyard and said, congratulations, that's great, you're gonna be on the vineyard, you're gonna enjoy yourself, have all this money rolling in, and then 8 months later you see your friend, I see Andrew, I said, what happened, how you doing? Terrible, terrible. I said, well, what's the matter? He said, oh, the vineyard's okay, it's nice, but the manager, the guy that manages it, he plays golf all day.
Icahn uses leverage to maximize his investments, which involves using borrowed money to increase his buying power. This can be risky, but Icahn's deep understanding of market dynamics and company fundamentals typically guides him to make calculated risks that pay off. Icahn is a strong proponent of improved corporate governance. He believes that many companies suffer from poor decision-making by boards that do not necessarily prioritize shareholder interests. Through his involvement, he aims to enhance transparency and accountability, ensuring that companies operate more effectively and beneficially for shareholders. Icahn's activity have not only led to significant financial returns, but have also propelled changes across corporate America. His interventions often led to debates about the role of shareholders in corporate governance and the impact of activism on the long-term health of companies.
Because we had those credit spreads on, and I think they're right there again.
Are you hedging out the long portfolios by being short the junk market?
Short the junk market is, what I do is arcane. It's an arcane way of doing it.
But you're doing
you
it
put on a
through
credit
derivatives.
spread. You
Right.
do it, you buy CDS.
Correct.
You buy insurance in a way, and it's a little complicated. It's not hard to do it, but it's very hard to explain.
How did you get into, when did you start thinking about not just being an investor, how you define activism?
Yeah, you look at a company, and we look at the beginning, and you'd study it, and again, I'd spend 5 hours a night till 2 in the morning looking for companies, and you look at them and say, this company is amazingly cheap. It's got great assets. It was easy to do with that. Great assets, but they're not making any money. And then you look and say, why don't you make money? And you'd start talking to guys that understood the company better than I did. An analyst. He said, the reason, Carl, is that it's not great and doesn't have a great name, great this. It's the guy that runs it's an idiot.
Carl Icahn's aggressive yet strategic approach to investing, characterized by his active involvement in corporate governance and his knack for turning around underperforming companies, sets him apart as a titan in the field of activist investing. His legacy is defined not just by the profits he generates, but also by the systematic changes he drives in the companies he selects, influencing broader market practices and corporate governance standards. We've explored the unique strategies of investors like Warren Buffett, George Soros, and Carl Icahn, showing what sets them apart. These legends don't just play the game differently, they change the rules. Subscribe for more insights and learn how to invest like the top 1%. Stay tuned and transform your investment strategy.